What's up, everybody? Welcome to the life cycle of a trade, the series where we break down the thought process behind trade entry, trade adjustments, and closing order. In this video, we are going to cover a call diagonal. All right, so we've got a little bit of a pullback in the market, but one stock in particular has just been whacked in the overnight session here, and that is McDonald's. There was some E. coli news that came out. The stock is down, let's call it 7% right now. It was down all the way down to like 280 something at some point in the overnight session. So it definitely has had a big pullback here. It's a relatively low implied volatility underlying most of the time. But currently, because of this move, you can see IV rank getting into the 100 handle. Over 100 means that it's exceeding its 52-week high today, right now. So it's as high as volatility has been. I think this is an interesting time to get a little bit of long delta, be a little contrarian here into this move. Again, 20-point move. We've erased, a month and a half, 2 months of price action here, even though the stock has had a very significant rally of late. I'm going to look at a call diagonal spread, even though, again, because volatility IV rank is high, it doesn't necessarily mean that actual implied volatility is high. The actual implied volatility in McDonald's is actually relatively low when you look at this, 20%, 24%. So it makes getting delta cheap. If something has high implied volatility, it's expensive to buy delta or to get delta via long premium. When volatility is low, it's relatively cheaper just because of the difference in the volatility here. So we're going to look at December. Let's buy this 300 strike. It's the first strike out of the money, but we've got $5 wide strikes here. I'm going closer at the money because I know that this is going to be a relatively cheap call diagonal spread for me relative to the width. It's going to be used $500 or $600, $700 in premium here. Now the high we got to, and we could see this here, 52-week high of 317. Let's play for somewhere a little bit under the 52-week high here. We'll go to the 310 strike for our short option. Now, I'm picking up 18 long deltas here in a stock that's trading at, let's just round it and make it $300. So we're getting, $3,000, $4,000 worth of exposure in delta for just $500 or $600. So this is a reflection of two things. First of all, the leverage that you get with options, as well as the low implied volatility here. Again, I said it was cheap to get delta here. It's cheap to get exposure to stock, or in effect, delta, via this call diagonal spread. So stock is rallying here. So this spread has moved pretty significantly. Just to show this on a risk profile at expiration is kind of a hard look because these are calendarized. I like to go to this Theo. This is kind of what our risk profile looks like. So basically a 50-50 shot. Using the analysis mode here, we can actually kind of simulate the passage of time. You'll see the risk profile move in that way. You can even take out some implied volatility. You could take out some from the long option as well. So you can see it's got a very interesting asymmetric sort of upside to this position. And as we keep waiting, we are missing out on some value here. So we'll see if we can get filled at 590, 593 here, 595. You can see the stock is rallying a little bit. It's at 296 now. So we'll try at 595, see if we can get filled somewhere around that. Probably going to have to move it up to 310. That's probably where we'll get filled here. Routed it at 310, got it price improved at 604. A little bit of long delta in McDonald's into this dip, basically at the high of the session. This might be a good timing on that trade. Do have a position that we have to manage today. One of our winning trades, we had a McDonald's position. It was trading at 297. The stock has rallied about $3 or $4 from here. We had a slightly bullish lean with a call diagonal spread, but really a lot of the value has come from this short option that we sold in the November monthly expiration at the 310 strike. We can go and look at that here. Just to give you an idea, it's trading at about 35 cents-ish right here. When we put this trade on, it was trading at about $4, and that's come from
Time decay, changes in implied volatility. Volatility has come in significantly after that big drop. So we've gained about $3, almost $4 in value out of that option. That option we sold at $3.90 is now trading at 30 cents. So with that position, the long option has only come in about $2, even though the stock has gone basically nowhere. So we bought it at 10 and it's now trading at 7.59. So we've lost $2.50 from the long option. We've gained almost $3, $3.50 on that short option. So most of the value came from the short option. So that value is what is giving us this profit potential. Selling out of the December call, buying back the November position here. 7:30, we got filled about 2 cents above the mid price, closing that one out for $126 profit, about let's call it 20% return on capital, 30% there. So nice little trade over about a 3-week time frame.